Thank you. Good afternoon. It's a pleasure to speak at the Empire Club again. First time I spoke at the Empire Club was in 2005, to show how old I am. I said then that it wouldn't matter to bullion investors if the gold price ended up the year at $400 an ounce or $500 an ounce, based on what the long-term trend is going to be. Well, gold ended up the year at $513. In 2019, gold had a good year. It was about 18%. But what surprises many is that since 2000, gold has averaged 11% across all currencies. 11%. 9.7% in the US and 8.8% in Canada. Now, according to the OECD, the average 15-year pension return is 6.6% in Canada and 2.6% in the US. Now, you don't need to be a mathematician or need a complicated algorithm or a computer to conclude that if you add gold to a portfolio, it'll reduce volatility and improve returns. Most pension funds, there's only 3 that I can think of that have any gold in the pension portfolio globally. 3 pension funds. And other than the big ones, none have real estate, but none invest in real estate investment trusts. If you look at the comparison, you can see in this chart the returns of gold bullion versus pension fund returns. Now today, investors are euphoric with financial markets and they're setting new highs every day, but they're highly overvalued by every conventional measure. So this year I promise my standard offering of doom and gloom, but I'm also going to present a contrarian strategy for protecting and even profiting during the inevitable market correction. This is the first time in the 40 years that I've been in the business that we have a simultaneous bubble in equities, bonds, and stock, and in real estate. Simultaneous. In all the other cases, it's been one at a time, not all 3 at the same time. And there's a direct correlation, with the amount of liquidity that central banks are injecting and the inflated asset prices. Now, according to David Stockman, he says we have the greatest mother of all bubbles, and there's nobody left in the stock market today other than drugged up day traders and robots who are being mainlined by the daily injections of liquidity from the Fed. This is utterly irrational. This is kind of a big picture overview. First we had a tech bubble and a housing bubble, and today we have a triple bubble. Many economists and financial analysts believe that the next correction will be worse than 2008. Some think it'll be worse than 1929. Just to put it into perspective, in 2008, the total U.S. federal debt was $8 trillion. Today, it's $23 trillion. In 1929, it was only $17 billion. The 2008 crisis was precipitated by a Lehman collapse. But today, the Deutsche Bank would be 10 times that size. Deutsche Bank has $48 trillion in derivatives. Is one of the largest derivatives books in the world. And to make matters worse, margin debt has increased by 223% since 2008. So in a correction, margin calls will precipitate the decline to be a much faster decline. According to Case-Shiller, U.S. real estate prices are once again at the highs reached in 2007. There's over $12 trillion of negative yielding sovereign debt. And the U.S. equities have been in the longest running bull market in history and have increased by 480% since the 2008 crisis. In both real estate and equities, individual and corporate earnings have been in decline, but prices for both real estate and equities have risen. So a 50,000-foot overview of this chart going back to 1929 is what this looks like. So you can see we have the second highest ever equity market running the longest ever. Sooner or later, there's going to be a correction. If we correct down to the bear market average, that's 37%, and if we overshoot it, it's at least 46%. 46% decline. Most cases, when you have an overshoot to the downside, it will overshoot the conventional averages, so it should be much worse. Now, the 2008 crisis was caused by largely 1.2 trillion of subprime mortgage debt. Well, today the student loan debt is 1.6 trillion. Global pension funds are underfunded by 78 trillion in unfunded liabilities. This is during the biggest bull market in history, underfunded by 78 trillion. That's not an amount that the central banks of the world can easily print. Of the S&P 500, 25 of the largest companies have pension liabilities of 151 billion. And in the U.S., if you combine the public pensions and Medicare, they're underfunded by 120 trillion. That's 367,000 a person. In Canada, public sector unfunded liabilities are 2.2 trillion, or 243,000 per person. Companies listed on the TSX have 100 million in unfunded liabilities. So since these liabilities were incurred during the largest bull market in history, it is likely that during the next correction, the losses in pension assets are going to become unfunded liabilities. Now, the pension problem isn't an academic exercise or a theory. In California, a number of the municipalities managed by CalPERS have already sent out notices to the retired teachers, firemen, and policemen that, so sorry, but from now on, your pension checks are going to be cut by 50%. In the U.S., the Pension Benefits Guaranty Corporation is projected to collapse by 2025. If it does, it would leave retirees with 2% of what they expect. Now, the riots have already started. Paris, Chile, these riots took place simply because logical pension reforms were suggested. We have riots for that. Since most pension funds, other than the very big ones, only hold stocks and bonds, there will be class action lawsuits when pensioners don't receive their promised pensions. It always happens. Lawyers clean up. There'll be absolutely no justification why CEOs, plan administrators, and portfolio managers fail to diversify their portfolios. There's 7 asset classes, not 2. There is no excuse for eliminating the best performing asset classes. Now in this chart I have 5 asset classes. I've left out commodities and collectibles since there's no convenient way to deal with them. But surprisingly, real estate investment trusts have been the best performing asset class the most frequently, gold the second, followed by stocks, bonds, and cash. Other than what's best performing, what this chart tells you right away is the importance of diversification, because they keep changing, like it's a moving target. So the plan is to diversify, but yet nobody does. In the future, it'll only take a small percentage of the 350 trillion in financial assets to reallocate to gold to cause an exponential price spike. Mine production and new discoveries are in decline, and central banks are setting records in gold purchases. There is only about 1.9 trillion of above-ground bullion available. This doesn't count the jewelry, the central bank holdings, and so on. And since most of this is already held by the world's wealthiest families, it's unlikely that it would come onto the market at any price. The bottom line is, unlike paper assets, which can be created without limit, gold supply is known, it's limited, and can only increase with actual mining. When it becomes obvious to market participants that the next correction is upon us, it will become difficult for pension funds to achieve a meaningful allocation without driving the price to multiples of today's price. Now, this quote is one from Ray Dalio, who runs the largest hedge fund in the world. And he says that in his roughly 50 years of being a global macro investor, he's observed that there to be relatively long periods, about 10 years, in which the market and market relationships operate in a certain way, which he calls paradigms. Most people adapt to and eventually extrapolate so they become overdone, which leads to shifts to new paradigms in which the markets operate more opposite than similar to how they operated during the prior paradigm. So one of the things I promised to say, okay, well, that's enough of the doom and gloom. What do you do about this? So we've been studying this situation for a few years, and one of the conclusions we come to is the conventional wisdom of always staying invested doesn't work. It doesn't work when you're at the end of the current paradigm. This chart shows that if you held your position in 1929, it took you 67 years to break even on an inflation-adjusted basis. Now, clearly, most people weren't alive by then to break even. The 1999 high-tech bubble didn't correct till 2018 on an inflation-adjusted basis. Again, a long time to wait. This is where gold comes in. Now, normally, a 20% allocation of gold will improve returns and reduce volatility. But during market corrections, you get a dramatic input. These are all the S&P 500 declines. And you can see the rise in the gold price is almost diametrically opposite. It's during these declines that gold transfers wealth. So we have to ask ourselves now, how close to the edge of the cliff do you want to go? So do you think that the next 10 years will be like the last 10 years, and the S&P 500 will go up another 480% to 37,000? Or are you going to have a retracement back to 3,200? Historically, great fortunes have been made by those confident enough to exit the markets before the downturn and park their money in real assets such as gold. Then you re-enter the market at significant discount when the correction is finished. Central banks have been setting records buying gold, and many ultra-high net worth investors have already allocated to real assets and gold. In the current bubble, we have looked at this and modeled a strategy that uses an initial tactical allocation of 100% to gold. A lot of people find that amazing. But when you consider it, is that when the inevitable correction completes, you've made money in gold and everything else has lost 50 to 70% of its value. It's then that the bargains rise. We've back-tested this strategy as applied to the 2008 crash using actual performance data. The model we got generated 25% a year returns. Now we've created a hedge fund that follows this strategy. So in conclusion, I encourage everyone to take a hard look at this and do some serious soul searching on this issue. It requires foresight, independent thought, and immense courage to swim against the tide of popular thought. But the rewards of preserving and possibly greatly enhancing your family's wealth for generations will be worth it. So in 2020, I think it also won't matter if gold ends the year at 1,500 or 1,900. As I have set out in my book, it'll go much higher in the future. Thank you.